All right, today we're talking about portfolio setup and management. In my portfolio, this is how I prefer to do it. I have just one or two of my favorite ETFs, and the point of this is to make sure that I'm diversified and they usually follow my main strategy. And then I have a long tail of individual stocks that I want to have more control and direct ownership in. So, for example, if I think Microsoft is going to do really well over the next 5 years, I can directly buy some more of it instead of relying on it in JEPI. But this is quite complicated, and for most people, this is not the way you want to go because there's too much maintenance, you gotta stay on top of it, and that all works against you in the long run. In fact, there's tons of articles like this on mistakes that individual investors often make, and it makes a great case for why this piece of advice from Warren Buffett is true. And he says for most people, the best thing to do is owning the S&P 500 index fund. And I've done this for most of my investing in life. I've been investing for 6 years, and for like 4 of those, I've just had the S&P 500, and it's done very well with zero maintenance. So what I want to do in this video is I want to go through my sample portfolios, which are very simple, but kind of one step up from just owning the S&P 500. They're still very simple, yet extremely effective, especially this last one, the simple split. This has a special elegance to it, and I'm very excited to show it to you guys. But before we can dive into the portfolios, we have to first establish what makes a good portfolio. So after going through those articles and combining that with my own experience, in my opinion, these are the main reasons why people underperform the market. Number one is yourself. You have to protect your portfolio from yourself at all cost. No matter how good of investments you choose, there's always going to be ups and downs in the market. And as humans, we are subject to emotions and things that evolution put in us over the hundreds of thousands of years that are going to actively work against us if we want to maximize total returns. So this illustrates some of those emotions. We have optimism, euphoria, fear, depression, panic. These are all things that will happen as you invest. So one, it's important to understand how humans react to things and our emotions, and two, to preemptively protect your portfolio from yourself. I mean, I would go as far as saying that what makes an investor exceptionary and better than their peers is their ability to understand how the human brain works and use it to their advantage. Fear, for example, is an extremely strong emotion, and you can let that dictate investment decisions, or you can use fear as a compass to guide you. Because another observation that usually works in the market is to take your instincts and do the complete opposite of it. When people are getting greedy, that's when you should be fearful. And when people are afraid and panicking and selling, that's when you should be greedy. Of course, that's easy to say right now abstractly in a video, but the ability to just understand how your emotions impact investing and then using it to your advantage is a huge bonus. So you absolutely have to protect your portfolio from yourself. The second thing is the concept of buying stock. When you talk in terms of ticker symbols and stocks, you kind of remove yourself from the business itself, and it's very important to remember you're investing and getting ownership in high quality businesses. And that leads to number three, which is invest, not trade. Trading assets back and forth is a very difficult way to consistently make a lot of money. However, one proven way to become wealthy over time is to constantly acquire assets that generate cash flow. That's it. If you accumulate assets, that's how you can become rich. Trading assets back and forth constantly and trying to make a small spread isn't nearly as effective. All right, now let's move on to things to avoid. And I just got two. And the first one is FOMO. So this stands for fear of missing out. And this is a visual representation on what FOMO is. Lines that go up and to the right aggressively. People chase the price appreciation. They want to participate in the gains. They don't want to be left behind. And this is FOMO. And it ties into one of my previous points on you're not buying ticker symbols and stocks, you're investing and getting equity in companies. And when you look at it through that lens, it doesn't make much sense to be buying it up here at a very high valuation when you could have bought the same asset down here. It was always the same asset, but back here, you didn't care about it. But now you have FOMO. And the second one is FUD, and this stands for fear, uncertainty, and doubt. And this is the visual representation of FUD. The trend changes, it comes crashing down, and you begin to question why you invested in this asset to begin with. You have tons of fear, uncertainty, and doubt, and FOMO and FUD are two sides of the same coin. Usually people FOMO into assets at high valuations, and then they sell them low when they begin to go down because of FUD, and they don't actually want to be owners of the asset. They just bought it because it was going up, and now because it's going down, they're selling it. And that leads to underperforming the market. And then my last section is things that you want to actually do. And the first one, without question, is to have a goal. If you don't have a destination, you're never going to arrive anywhere. So definitely set up a goal. What do you want to accomplish through investing? And then the second one is to be consistent. Once you have a goal, actively work towards it every single day. It's not going to accomplish itself. And the last point is to remember that you are your own worst enemy. That ties back into the very first thing, that you are the main reason why you underperform the market. It could be because of all these reasons. You're trading instead of long-term investing, FOMO, FUD, or you just don't have a goal. So always remember that you are your own worst enemy. And every time you want to make a major change in your portfolio, remember this point and ask yourself, why are you making the change? Okay, so let's get to these sample portfolios. The first one is growth and downside protection. And again, we're keeping these simple to protect it from ourselves. So this is just 4 ETFs. And something to note, kind of a disclaimer, is you can use any ETFs you want, but I'm going to explain the logic behind the kinds of ETFs I chose and how they work well together in any market condition. So as mentioned, this is growth and downside protection, and that's why I have 2 growth ETFs. VUG, which is a generic large cap growth ETF. This has all the names like Amazon, Facebook, Google inside of it. So it's very safe. It covers your bases no matter what market condition. And then I have a more speculative risky ETF. This is the ARK Innovation ETF. It's way more volatile, but it has the potential to give you great returns. And then I have 2 ETFs that kind of offset these because they offer downside protection, they have a lower beta, so less volatility, and they give you income. So the first one is NUSI. This one has a put option, so it has very low volatility, and it's kind of the opposite of the ARK fund. I mean, the ARK fund has a ton of volatility and upside protection, and NUSI is the exact opposite of that. So they help to offset each other. You still have lots of income from NUSI and capital growth potential from ARK. And then same thing with JEPI. JEPI has some downside protection as well as more upside capture potential while driving more income. So that's a good pair with VUG. So together, it's a simple portfolio of 4 ETFs that complement each other quite nicely. If we look at the past 12 months, it's up 27% with a dividend yield of 4.175. So these are extremely respectable numbers. This next one is dividend growth, keeping it really simple, and just 2 ETFs. These are 2 of my favorite pure equity ETFs. I think if you buy these and hold them long term, because of the compounding effect of the dividend growth rate, I really can't see you going wrong with this. So we got SCHD, which has some of the traditional large cap dividend companies, and then DGRO, which is kind of a mixture of dividend and growth companies. Great ETFs. I think they work well together. And again, because of their fast dividend growth rates, both of them have a growth rate in their dividend over 10% per year. So if you hold these for 10 plus years, you're going to have an extremely high yield on cost and great total returns. Okay, now that brings us to the last one, the simple split. And I think this is the single best option, and it's the one I recommend to all my friends and family. And the first thing you're going to notice is how simple and elegant this portfolio is. Again, protecting it from yourself and your urges to want to change it. So all we have here is SCHD, which is large cap dividends, and SCHG, which is large cap growth. Essentially what this is taking the S&P 500 ETF and splitting it into 2. So we have a dividend half and a growth half. And in the past year, keeping it just at 50-50 each, and it's gone up 36% and has a dividend yield of almost 1.6. In fact, during that same time, the S&P 500 went up 33% with a dividend yield of 1.25. So what we can do is we can go back to that portfolio and adjust the allocation. If we do about 35% in dividends and 65% in growth, I think this is going to be a great approximation of the S&P 500. And it has. It's gone up 37% in the past year with a dividend yield of 1.2. So this is essentially the S&P 500 split into 2 ETFs. And the magic here is it gives you the ability to tweak the allocation over time. So if you're young and you're just starting out and you want more growth, you can do that. You can put, say, 80% into the growth half and 20% into the dividends. And this is what that looks like. You have more capital appreciation and a smaller dividend. And then without even buying or selling any additional ETFs, you can just change the allocation over time. So as you get older, you can change to 50-50 and even ultimately 20% growth and 80% dividends as you get older. And because this is super well protected from yourself, you're going to be holding it long term, you're going to be allowing these ETFs to compound over time, especially the dividend ETF. Because as mentioned, SCHD grows their dividend roughly 10% per year. And if you can hold this for decades on end, that becomes super powerful. In fact, here's a dividend growth calculator, and I put in roughly the same numbers for SCHD. And we can just see how over time, your yield on cost goes up immensely, and the annual dividend payout just becomes huge. So Warren Buffett recommends just owning the S&P 500 ETF. But I gotta say, I like this a little bit more. It's very similar. You get a lot of the same benefits as owning the S&P 500 because it's still simple and it's going to protect it from yourself and always wanting to change it around. But it gives you just that extra bit of control to dictate if you want more growth or more dividends. And you can adjust it over time just by messing with the allocation and never buying or selling any ETFs. So if you want my opinion, this is not only one of the best starter dividend portfolios, but one of the best portfolios one can make. It's simple, yet elegant and effective. I hope you guys enjoyed the video. If you're still watching and enjoyed, give it a like, subscribe to the channel, all that YouTube stuff, and I will see you in the next one.